I'm Oliver Sloup with Blue Line Futures, coming to you from the Chicago Board of Trade with another episode of Tech Talk. It is Tuesday, July 5th, and we saw extensive pressure and a lot of commodity markets coming back from this long weekend. You can see here we've got the FinViz site pulled up here that breaks down a lot of the more popularly traded commodities, and outside of canola, lane hogs, there was a lot of red on the screen. Crude oil taking the most heat in today's session on a percentage basis, trading as much as $10 lower here this afternoon. Obviously, that drags some of the agricultural commodities lower as well. And this kind of goes with the theme that we've been talking with clients about for the last couple of weeks, is that the inflation story has broadly run its course, and a lot of funds piled into the commodity sector before inflation became an everyday talking point, and their exit isn't going to be any different. It's like that old saying, buy the rumor, sell the news. By the time people realize that something has happened, it's already happened and gone, and we're pricing in future developments. And I think that's what some of these commodity markets are starting to do, is reposition here as we enter the back half of the year. Now, with that said, a lot of technical levels that came into play today. Let's look at the charts. We've got September corn here pulled up first. Friday's close was not what we wanted to see ahead of the long holiday weekend. A break and close below the 200-day moving average, as well as support, which was a previous high before the big breakout move in the Russia-Ukraine invasion. That set the tone for negative price action going forward, as if this previous week wasn't enough. And we've gotten some decent beneficial rains through parts of the Midwest over the long weekend as well, which led to additional long liquidation. If you're looking for a silver lining, I think it's the fact that we filled this gap all the way back from February 7th and are approaching significant support, which was previous resistance all the way back in November, December, and then the eventual kind of stair-step higher and breakout point of January. Now, we like the risk reward here to the buy side. Now, with that said, a break and close below the low end here, call it 565 for round number purposes. That's your ripcord, where you take your medicine and move on and let the dust settle, wait for another opportunity. But again, I think there's a good risk reward here to the buy side. We have had a bearish bias, or at least in bearish territory, for the past several weeks now with this seasonal trade. This is the Grain Express that we send out each and every day. The seasonal play, we've mentioned this several times, through June 13th to July 27th, it's been profitable to the short side 13 out of the last 15 years, and that's about to add another year to the tally. But from a technical perspective, I think we're approaching a point of good value, or at least from the risk-reward standpoint, it appears to be good value. So that's what we're looking at for September corn. Moving over to August beans. August beans, we thought that the 200-day moving average would hold a little bit better. That comes in at 1456 today. Right near there is the 50% retracement, or basically the middle of the range. From these lows back in November to this spike high back in February, we weren't able to defend that, which isn't necessarily a good sign, but I still wouldn't be surprised to see if beans can maybe find their footing a little bit, work their way towards this gap. I don't know that they'd be able to fill it, but at least work their way back here in that 1495 to 1505 area. And that's what we're looking at there. Obviously, we're getting a little oversold, but this is one of those environments where you take oversold with an extra grain of salt, because money flow is what it is, and sometimes it can go a lot further than people think, whether that be to the upside or to the downside. We've seen it to the upside, back here in February, we took off and saw this RSI at 81 plus on multiple occasions. Typically anything over 70 is considered overbought. On the flip side, anything below 30 is considered oversold, and right now that RSI is at 2880, so technically oversold, but not a good enough indicator to step in on the buy side. And I mentioned a good risk reward trade with the corn market down at those levels. I don't see the good risk-reward trade here in beans. Potentially we pop, but there's not a whole lot of support until you get down here closer to $14, which were these previous highs back in January. So soybeans, we've got a slightly bearish bias in the daily reports. From a new position standpoint, I don't see a whole heck of a lot to do there. So just kind of brushing up on some of the technical levels that have broken down here over the last couple days. Now, moving over to the wheat market, wheat has been more or less a waterfall after breaking and closing below this little sideways channel that we had, and we talked about that opening the door for a run down to 960 area, break and close below there. The 200-day break and close below there is where we're at today, which were these previous highs back in December and January. That comes in closer to 815, just below that. $8 psychologically significant. This area is a must-hold area for us. The bulls need to really find their footing. Again, as with corn and soybeans, we've had a bearish bias in our daily reports, but I think we're approaching a point where we might be able to find at least a relief rally, but we need to get conviction close or consecutive closes back above 815 to feel good about making our tracement back towards that 200-day moving average, and this breakdown point from June 30th that comes in closer to 910. A failure to reclaim ground above 815 keeps the door open for a retest of these lows back in January. That comes in closer to 743. So those are the levels that we're looking at for the September Chicago wheat contract. Wrapping things up with the live cattle market. Friday, we went into the long weekend thinking, wow, all cattle needed to do to rally was turn the calendar over, get to a new month and a new quarter and a new half, and the funds would be positioning in an optimistic manner buying cattle. Well, today we gave that all back pretty much and retreated back towards where we were Thursday into the close into the early afternoon. The failure against the 50 and 200-day moving average is not what we wanted to see today. There was a lot of outside market pressure. Potentially that played a role in things, but the bulls need to see consecutive closes out above these key moving averages to encourage momentum traders to step in. The cash market still relatively firm, which we thought would have been a bigger catalyst to get people excited about being long cattle, but as I've alluded to in previous tech talks, it is a revolving door of disappointment in the cattle sector. If we can't get our footing here this week, 130, 132 isn't out of the questions in the near term. We remain optimistic, but are expecting disappointment because that has been the common theme, being bullish or optimistic live cattle future. So that's what we're looking at. That's what you should be looking at too. This has been Oliver Sloup with Blue Line Futures from the Chicago Board of Trade. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.